Hey everyone, this is Spectre Trader with Semantics Trading, coming to you with your daily report. So today, in the pre-market, we had the CPI number come in harder than expected, and we did have a nice 100-point move down on the ES right off of that release. But we can see that the shorter term time frame players on both sides got caught with no resolution as the markets ended up chopping around all day. The shorter term bears who chased the market off of open got caught with their pants down as the futures absorbed the brunt of the move in the pre-market with many stops gapping down. However, when the markets opened, we had a decent sized rally off the lows, up nearly 100 handles at one point before the momentum died and we fell back into the middle of the range around close. And that is one reason. That is one example of why you don't ever chase a move that has already happened, as it is better principle to wait for a key level to see if there's exhaustion to fade off of. And going into tomorrow, I do want to see if we could hold 3750, which is a key area, as sellers cannot find any resolution to the downside at that area. And if that were to break, I would want to see 3720 and 3700. For the upper resistance, I do want to see how we react to 3800. If that is taken out, then the next level I want to look at is 3843, which is where volume drops off of if you look at the profile. Personally, on a more medium term time frame, I am leaning towards a rally towards around 4,050 before we see longer term time frame players step in and sell the market. In the big picture, I do think that the summer will be a large range-bound summer without any proper direction, and we will likely just be testing the upper and lower parts of the range with no proper new trends. And if we look at the CME Fed Watch rate hike odds, it shows that the futures have been pricing in more than an 80% chance of a 100 basis point Fed hike in July, which is the first time and a very aggressive rate hike due to the continuous soaring inflation rate. And as a result, this will cause interest rates to increase a lot, and it makes it more expensive to borrow, so there is less spending and demand tends to go down. The US CPI month over month was 1.3% actual versus the forecast of 1.1%, and the previous was 1%. So inflation is still coming in hot. We did see the dollar have some strength today before having a bit of a sell-off after the IB period. The CPI also was a fresh 40-year high, historical high, so that's a very notable thing. But I think the market has been quite used to seeing these high inflation prints, so I don't think it necessarily spurs any massive fear, as the market has becoming more conditioned to it. If you look at the bonds, the 10-year Treasury yields dipped while the 3-month Treasury yields went up, which is a bad sign for the future, as investors expect longer-term Treasuries to go down in the future, which means that investors would rather buy bonds than equities, reducing equity risk premium, which an equity risk premium is additional expected return of equities over bonds, and this is causing stock valuations to decrease in the future. And with that being said, that's pretty much it for today's recap. It is a short one, but we are launching our chat room, where it is a Discord community where It's run by a group of traders who are seeking to educate and also connect like-minded individuals who are interested in sharing ideas and collaborating. So be sure to check out a link in the description for more info, and we hope to see you in the chat. Thanks again.